Hello and welcome to another episode of Macro Monday. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
And I'm Will Cunliffe, a research analyst here at Onyx Capital Group.
Today we'll be looking at how the markets have reacted to the US bombing of the Iran nuclear facilities. We'll also look at last week's data. US data is continuing to weaken.
We'll have a look at the recent FOMC and the revised SEP projections, which are looking a little bit more stagflationary. We'll also dive into the ZIRP, which is back in Switzerland.
Yep, zero interest rate policy is back.
Yeah.
Let's go straight to the events of the weekend. The US, of course, bombed the Iran's nuclear facilities. Let's look at how the markets reacted. Let's go straight to the Brent price.
Yeah, I mean, Brent was a pretty big reaction, at least initially. We saw the market open way stronger, up at about $81, just shy of. That's the highest flat price we've had since the 20th of January. So,
but the price is now where it was on Friday's close, and yet we've had a huge event.
Yeah. I think the market is it's downplaying a lot of the risk from here. Before, when we've had escalation, the kind of the retaliatory stage, it's always been, if nothing's happening, the longer nothing happens for, the less likely anything will happen. Over the weekend on Sunday, we saw some Iranian strikes in Israel, which Iran said were in response to the strikes at Fordo and the other two nuclear facilities. And that they will be reluctant to strike any US assets. I think that would be...
They've said they will, and they've also said they'd close the Strait of Hormuz, which we don't believe. But...
Yeah, I mean, it's not new from Iran to be threatening closures to the Strait of Hormuz. They haven't done that since the 70s. For me, at least, a US or Israel bombing of Kharg Island, taking out export infrastructure there would be a prerequisite for complete closure.
But they're not going to do that because we need oil supply.
Exactly. So you have Trump here kind of talking up the conflict a little bit, showing signs of US strength, bombing key nuclear facilities. But realistically,
he's no longer a taco president.
Well, yeah, we'll see. I think they'll be reluctant to take off any oil capacity. I think his core goal is cheap gasoline, cheap oil, and that would directly jeopardize that core goal.
And also, of course, from Iran's perspective, their key ally is China. And what percentage of Iran's oil goes to China?
It's a good chunk of it. I don't know. I think
it's close to 80%. So there's no way they've threatened, and it went through Parliament and it was approved.
Yes.
But there's no way they'll close the straits because.
But we did see a Chinese chartered VLCC U-turn just outside of the strait. So it is disrupting oil flows a little bit already. We've seen Maersk already cut their voyages, their transits through the Strait of Hormuz. But you have to remember that they're defending equity prices as well. A lot of the kind of more smaller ship brokers, that aren't publicly traded, are still transiting. We've still seen oil flows largely undisrupted. This morning, the Dubai window was reasonably active. It's been a quiet month on the whole, even prior to the escalated tensions in Dubai. But largely, spot market activity is as usual.
Shipping prices have spiked this morning, haven't they?
Freights jumped. We did see kind of on last weekend, we saw freight from AG to Asia jump about 20%, but we saw freight from WAF to Asia jump about 40%. So there is a lot of rotation in demand in the crude basket as well towards those kind of safe grades, those grades that aren't at risk of force majeure. But nevertheless, I think that, transits through the Strait of Hormuz, although they might be more expensive because there's a risk premium now, that they will still go ahead.
So we'll show the slide, the long-term chart of Brent oil in a second, which is clearly going higher. But where do you think oil will close tonight? Because we've had this spike, it's sold off.
I think it's heading to 74.
Okay. Then
I think it's heading
if the
down.
market's crowded longs, then it's a pain trade and they start to get stopped out.
Exactly. And as we see on the next slide, Onyx's proprietary CTA positioning index, it's all long across the board,
That's incredible.
across barrel. CTAs have been increasing net length, and this is normally a key sell signal among those trend following algorithms. So we might see kind of profit taking here, and an unwind of that concentrated length. And it's the same thing on CFTC. So if we check out the money managers CFTC length in the next page, ever since kind of the 13th of June, we've seen a big accumulation of length in Brent futures, and that's going to start to hurt a little bit if we start to see some profit taking and some reversal here.
Well, typically you get a retracement when the market gets that long.
Exactly.
Interesting. So if we move on to the next chart, you can see that the short-term trend is just clearly higher. It's broken key resistance, and again, if you look back to when Russia invaded Ukraine, it's almost looks insignificant. But we've had some banks coming out over the weekend, Deutsche Bank being one, saying that if they do close the Straits off Hormuz, then the price will go to at least 120. Now, we don't think they will, but you'd have thought that fear in the market alone would send prices higher. But the markets...
Yeah, I mean, Iran have been threatening closures to the Strait of Hormuz ever since kind of the first escalation. It works for them to threaten closure because they get more for their oil. It works for Russia for them to threaten closure. But it doesn't work for them to close.
Doesn't work for the economics of the country.
They need the revenue.
Yep.
And I think it'd be heavily diplomatically unpopular for them to close the Strait of Hormuz.
Yep.
That would put all of the Gulf states against them. That would bottle in all of your upper Zakum. It would bottle in all of your Kuwaiti crude as well, and it would not be popular. And I don't think Iran.
You're being very polite.
Yeah.
Heavily diplomatically favored.
It's highly unlikely.
Yep.
And I think the market is kind of responding to that to a certain extent as well. I think they're looking at the spot window and they're seeing, we already had an upper Zakum declared for August this month. And that's a grade that loads within the Strait. So I think oil will continue to flow. You might see some small disruptions the Houthis' activities in the Red Sea did disrupt flows, but still vessels do transit.
Yep.
And there's a lot of US military infrastructure in the region. There would be possibility for armed escort and things like that if Houthi activity were to accelerate in the region. And yeah, I think flows are largely going to be undisrupted, and that's the reports that we're hearing.
Yep. Actually, if you look at other markets, we'll bring the slides up a bit later, but if you look at the US equity market, mid-afternoon yesterday on Sunday, the weekend analysis was showing, weekend markets were showing it's going to open down aggressively. It opened down about 0.5%, but it's since rallied back to unchanged.
Yeah. I also think it was interesting how well telegraphed at least the decoy B2 strike was. So what it looks like happened was the decoy set of B2s went over the Pacific, which were trackable on Flight Radar 24. I
saw it live on X. It was bizarre.
It was so well telegraphed. And 2 days beforehand, there's reports of there's a lot of activity around Fudo, kind of moving, a lot of trucks, convoys, things like that. Prior to the strikes, it looked like the entrances had been filled with dirt. It seems like Iran knew it was coming, and perhaps the lack of retaliation and the fact that Iran knew it was going to happen might settle markets a little bit.
Also, it happened over the weekend.
Yeah.
So when Iran attacked a couple of weeks ago, Israel attacked. I mean, that was over the weekend. And when the strikes happened several months ago, that was over the weekend.
Yeah.
Is that purely to avoid disruption of markets?
I think that at least partially on Trump's behalf, for sure. If that had been on Friday, that would have triggered a pretty aggressive reaction, I think.
Yep.
The fact it happens over the weekend, it enables people to digest the news, and more news to enter the cycle, which dilutes the price reaction, I think. And that's largely what we've seen today.
Interesting. The one market that has moved and continued moving is the dollar's strengthened.
Yes.
But I think there's two ways you could look at that. Partly it's the fact that if there is oil disruption, Asian countries and European countries suffer. US, of course, is self-sufficient.
Yeah.
But the other point is, and we'll see in a second, the hedge fund managers shorts in the US dollar at the biggest positions in 20 years.
Yeah.
The market's massively short the dollar.
Yeah.
If you look at our LinkedIn page, Onyx Institute, we highlighted this on Thursday that the dollar had broken higher.
Yeah.
And now you're starting to see an unwind of those shorts. 4 stops in those shorts. So we've had dollar yen's gone up 100 pips this morning.
Yeah.
We're seeing the dollar index winding higher.
And then obviously you also have the FOMC last week, which painted a very kind of higher for longer narrative. Stagflation looks like in the central base case.
Yep. We have that
we'll
slide
talk about in a little bit. So yeah, it looks pretty constructive for the dollar at the moment, for sure.
Yeah. If we move on to the data last week, the US data continues to worsen. Also, the Fed's admitting stagflation, as we'll come to the slides in a second. But the US Economic Surprise Index is now the most negative it's been in 9 months. You can see this chart here. It's actually highly correlated with the 2-year. So typically you would see the 2-year yield come lower, the Fed cutting. But as you say, we had a Fed meeting last week. They revised higher their inflation. They revised lower unemployment, and they revised lower growth. Revised lower employment and growth. So it's all bad.
Yeah.
If I just read it out here, growth revised down in 2025 from 1.7 to 1.4. Unemployment's revised higher this year, 4.4 to 4.5, and core PCE inflation result revised higher from 2.8 to 3.1. I think what was a bigger, more critical is 4 Fed members at the last meeting expected Fed funds to be unchanged this year. That's now gone up to 7.
Yeah.
So we still have the OIS. This morning is pricing exactly 2 cuts by year end, 50 basis points. We have 7 Fed members of, let's see how many are, 19. So 7 of the 19 Fed members expect the Fed to be unchanged this year.
Yeah.
That's got to be bullish for the dollar.
Yeah, definitely. And, even with their unemployment projections revised up at 4.6%, is the Fed going to be worried?
It's still strong.
It's still very low. A lot of European countries would be very jealous of that statistic. Meanwhile, you have core PCE up to 3.1%. That's quite north of target at 2%. So they're going to want to really target that. And that's obviously the measure of underlying inflation. The headline statistic can oscillate above and below, but normally it does tend towards core. So with core higher than headline, that's going to be a concern for the Fed.
Yeah, and Fed Powell said inflation has been running somewhat above goal. He also said current policy stance leaves us well positioned. But what you had on Thursday, Fed's Waller came out and said the Fed is in position as early as July for cuts. So he's obviously one of the key doves.
Yeah.
And the equity market rallied on that. It didn't rally on the sort of stagflationary events, but it rallied on that. The equity market wants to rally on whatever good news it can.
Yeah.
You've had Jeffrey Gundlach, the bond market, the bond king, huge hedge fund manager. He's come out saying it's clear the Fed thinks the next move in rates is lower.
Yeah, yeah. And what's interesting as well is that they don't perceive uncertainty to be higher than last meeting, even despite all the tensions in Israel.
Middle East, that's unbelievable.
And even with Trump kind of going back and forth on tariffs now he's kind of moderated his tariff rhetoric a little bit, but you never know. Compared to their last meeting, they're seeing uncertainty as unchanged. So potentially, that could, if that starts to trend lower in their view, that could open the door for some earlier cuts in perhaps even July. I think July might be a bit soon, but
I think so, unless you see a deterioration in employment. Yeah. Because with oil price here, that's going to keep a bit under inflation.
Yeah, yeah. And at the moment, a key offset for headline inflation is energy in the US. We've got gas prices a lot lower gasoline prices much lower year on year. So that's really weighing on the headline statistic. If we start to see that base effect drop out due to the heightened geopolitical risk driving oil prices higher, that could see inflation really start to rise quickly.
Yep. Also, of course, last week we had the announcement of the US-UK trade deal. I think it was announced 4 times, and the final time Donald Trump opened up his file, it actually fell on the floor.
Yeah.
So, what are your thoughts?
Yeah, I mean, we've known for a while that Trump has a bit of favoritism among the European countries when it comes to the UK. He's
also, he had to reveal a trade deal, doesn't he? He's looking the whole trade shenanigans is looking so weak. It's abysmal. He needs some good news. Hence, he keeps announcing it. And
exactly,
that's one country out of an awful lot.
Yeah, and Keir Starmer's kind of done quite well in terms of getting trade deals recently. He got one with India as well, and one potentially with the EU. So I mean, it's looking.
He also needs as much support as he can at the moment.
Exactly. So I wonder how long it'll last. It's on autos, so, and obviously that's something that Trump that was kind of an industry he really wanted to guard when he came in to office, and that was really a kind of a point of his tariffs was to protect the US automotive industry.
Yep.
So we'll see what happens there, but it definitely is good news for the UK.
Yeah, and going back to car industry, I mean, I can't see how European car industry can survive with tariffs on one side of the US and China's competition on the other side.
Yeah, I mean, it's interesting because obviously you do have that core demand for European luxuries, like in the US, for example. They've always had pretty high tariffs, not as high tariffs as they do now, but they have been perceived as a luxury good. So you might still see a bit of inelastic demand support that. But I mean, in terms of competitiveness globally, there's one force that's dominating, and that's China.
Yeah, and from what I understand, talking to specialists in this area, Volkswagen is pretty close to a deal with Leaf, a Chinese car company, but the other German car companies are out on their own and just can't compete.
Yeah, no, for sure.
And they also have unions that want to go to 4-day weeks, which again is, in the current scenario, is not going to work.
No. And yeah, I mean, China, they just have the vertical integration along the supply chain is huge, from the mines in Africa all the way down to the kind of battery manufacturing in China and the end product. It's heavily vertically integrated, and no one else can compete with that.
Also last week, Bank of England came out unchanged. But what we've also had weak retail sales data out of the UK. So we've highlighted the data out of the UK is getting a lot worse. Employment's a lot worse as well. And what we had this time round was unexpected, was the BOE, the vote. Ramsden, Deputy Governor, he voted for a cut as well. So the Bank of England Policy Board are becoming more dovish.
Yeah.
I think we're going to see more cuts there. The economy is weakening. The chart we have up, you can see here, this is a pound against the US dollar. You can see it's nowhere near support at the moment. Support there comes in around 132.75. You can see from the short-term moving average, it's rolled over and the short-term trend for now is down. And I think that's going to continue. Yeah,
I mean, we've, especially compared to Q1, Q1 UK data was looking really, really quite strong.
Yep.
And a lot of the rhetoric out of the Bank of England was we don't need to cut that quick. We obviously, you have your permadoves there like Swati Dhingra who will always vote for a cut. But we've also had a pretty split committee. We had some members voting for 50, some members voting for 25, and some members voting to hold. So I think that's, again, a function of uncertainty in the broader economy.
The data, the retail sales are expected to come out down 0.5%. Month on month came down 2.8%.
Yeah.
That's huge. Catastrophic, but it is 1 month's piece of data.
Yeah.
And we can take that as noise. But if you get that 2 or 3, then you will see rate cuts pretty quickly.
Yeah, definitely.
Interesting point on that as well is terminal rates, the OIS, the overnight index swap, prices Bank of England a base rate to be at 3.55% next year, virtually the same as the US. Meanwhile, Eurozone at 1.69. So Eurozone much lower.
Yeah.
And interesting on that, we will look at OIS a bit later. But if you look at New Zealand and Eurozone, actually, there's no cuts priced in next year. The market's starting actually to look at, say, that the economies will bottom and start to pick up.
Yeah, interesting.
Which is a bold call.
Yeah, I mean, you've got a number of forces in Europe that might sort of drive that.
I should say, actually, at that point, sorry to interrupt, the market is normally wrong.
Yeah.
The market is normally wrong when it's projecting that far ahead.
Well, we saw OIS at the start of the year for the US. You know, we've come down from like 80, 90, 100 bips even, only a couple of months ago now to 50. So yeah, it's definitely uncertain looking out that far ahead. But I don't think it's unreasonable either. You have the huge fiscal package coming in Germany, and that will be incredibly supportive and probably a bit inflationary as well. So yeah, it's going to be interesting. You can't help but see a resemblance in some ways to the COVID era inflation shock there. Huge fiscal. It's the same in the US as well. If the Trump tax cuts come through, you have huge fiscal, but then you have tight supply, and then
there will be more pressure on the dollar and US bonds, which we'll come to in a second as well.
Exactly.
If we move on, another central bank decision last week, Swiss National Bank cut rates to zero. So ZIRP, zero interest rate policy, is back. The overnight index swap actually is pricing Swiss rates to cut again and be cut another 14 basis points over the next 12 months. So negative rates in Switzerland is looking very likely. Interesting chart here. This is Swiss yen. So what we have is the Swiss cutting and Japan hiking rates. Normally you'd expect the yen to benefit, but here you can see, well, this is part of the whole safe haven. The market loves the Swiss franc. Not only is it surging, it's just broken through the previous high. Huge move today here. And part of that has to be around the safe haven as well. But it's a bit odd saying that because oil's not spiking today. Equities are not selling off, but the Swiss franc is doing way better than other currencies.
Interestingly, neither Switzerland nor Japan have been foreign to open market operations in the FX markets either. So, we get safe haven flows to Swiss francs, but there's always a risk that the SNB might start meddling with them. So we'll see. We'll see what happens there.
But that's a clear break and a clear one-way trend. Moving on to equities. Equity market continues to look like it's on the cusp of a break lower. Here we have the S&P 500. Again, the futures, this is the cash close Friday night. The futures this morning opened down 0.5%, and that looked like then the moving average were clearly turning lower, but it's rallied. So I think if the market, if we do see the market close below 5,967, then we start to see more aggressive move lower, because longs will have that as a stop, and that's where stops are triggered. So they'll start selling. We've talked about this before. Retail have their biggest long position ever, but we've seen hedge funds reducing their position and going short as well. I don't see it's the environment for markets to be going up. And actually, if we forward on one slide, you can see here, institutional investors here positioning signals equity market declines. Non-dealer net positioning is the lowest in 14 months. Also on that, professional investors positioning is even more bearish than during the early August 2024 drop.
Yeah, I mean, we've seen...
sorry to interrupt you again. I love these correlations.
Yeah.
And they're out of line.
Yeah, so it's something's got to break towards.
Yeah, and that's out of line simply because retail keep buying.
Yeah.
And how does this always end? Is retail holding...
Yeah, holding the loss.
Exactly.
I mean, we've seen pretty extensive capital outflow from the US over the past few months, especially on the institutional side.
Again, that's institutional. Retail just plough into the... Again, a point on that. I was on the board for 7 years of the CTA, Chartered Market Technicians Association, biggest technical analysis body in the world, and it was all focused towards US equities.
Yeah.
And I helped drive that towards commodities, FX and bonds. And in the US, people don't look outside. They don't look at other markets. They don't look at other, when I say that, they don't look at other products. They don't look at other equities. It's just US and it's retail money. And they keep buying the dip.
Yeah.
But it cannot continue at some point.
Yeah, for sure.
The only time we'll find out when it stops working, it will be the price action.
Yeah.
We can predict as much as we want. I spent 28 years doing that and getting it wrong many times.
Yeah.
But it'll be the price action that will tell.
But I mean, you know, you also can't knock Trump's propensity for talking up the retail market as well. You see, it's the same with oil. If oil starts to kind of rally up towards that $80 level.
But he knows consumer confidence is highly linked to equities. So when equities go down, his ratings go, at the moment they're low, they go down even more.
Exactly.
So, again, I don't want to be a cynic and mention that, but yeah, he needs equities higher. We need equities to at least stay at these levels.
Yeah, and that's part of why he's really part of it's the bonds, but also the equities is why he's really pushing for a cut from the Fed. But I don't think he'll get one.
Yeah. And as data weakens, yeah, he needs that cut even more.
Yeah.
But the data's weakening, but it's not at critical levels.
No. And I mean, a lot of the soft data has actually started to improve in line with the recent bounce in equities. You know, consumer confidence was pretty strong last month. So
we have on Friday University of Michigan US consumer confidence. That'd be interesting to see if that gets hit by current events.
Yeah, definitely.
If we move on, the Nvidia chart, we mentioned this before. Michael Burry, his biggest position is short of that via options. Again, you can see that's on a knife edge. It's on a key trend line. The moving average is going sideways now, but there's key trend line support. But a break below 122, we'll see that. Again, stops triggered.
Yeah.
Doesn't matter what's happening with the company. If stocks get triggered, the market goes down.
Yeah.
Onto bonds. The 30-year bond remains just below 5%. Again, 518 is the key level here. No change on last week. But I think that 518 level is the most critical level in financial markets, because if 30-year yield goes above that, I think that's catastrophic for the US, the whole debt story, because bonds will get hit, they'll get sold aggressively, the dollar will get hit, mortgage rates will go up, that will affect housing even more. So that's just my view.
Yeah, I mean, the housing market is the clear loser in this situation from my perspective. I mean, we've already seen Freddie Mac and Fannie Mae coming out saying the Fed need to cut.
But again, if the Fed cut, the Fed funds rate is the overnight rate. That doesn't affect the back of the curve. And there's every chance if the Fed cut, the curve steepens.
Yeah.
Because that would be inflationary with the economy where it is, and that would send mortgage rates even higher.
It's true. It would allow the Treasury to kind of roll forward that issuance, though, issue more at the front.
It's not going to help the mortgage market.
But they'd be issuing less at the back. They'd be issuing like less 10-year paper, for example, and more 2-year paper, which could, you know, tighten supply demand in the back of the curve and support the 10-year, which is the 10-year is the key kind of benchmark for which 30-year mortgages price off. So that could help, but I don't see the Fed cutting.
I don't, not at all. And what I like is Powell's stuck to his mandate, and he's been very clear. He's been unpolitical. He's not got any petty squabbles and use any childish language.
The higher yields are, the higher the cost of rolling, the more issuance needs to occur. But interestingly, auctions have been seeing pretty decent demand still. So we'll have to wait to see if we start to see Treasury bill auctions.
But then if you're a hedge fund manager and you're unwinding your equity positions, where'd you put it? And gold's struggling at the moment as well. We'll have that chart in a second. Here's a good chart. This is the 2s, 10s. It's going sideways at the moment around the sort of 40, in the mid 40s. Really, the top of that, I see 63.42. I see the range in that. I think it will break high, but again, that's just my view. So treat that with a pinch of salt. But if the data continues to weaken, then the market will price cuts from the Fed. That would see the curve steepening.
Yeah, I mean, there's also another scenario where perhaps we do get that tariff inflationary impulse. We do realise some stagflation, and we see real yields kind of start to fall, which would weigh on the back. You know, so
you're taking the other side here. It's good. That's what makes a market.
Perfect. You know, like we could see a flattener. That's if managed money decides that the creditworthiness in the US is still there, it's still the safe haven that it once was. That's also tenuous. Credit default swaps on 10-year US bonds are now pricing below that on CGBs of equivalent maturity. So Chinese sovereign paper is perceived as risky of default as US sovereign paper now. So
it's interesting. It's going sideways at the moment.
Yeah,
I favour the steepener. You're on the flattener.
Yeah,
we'll see afterwards. We'll have a wager. We'll see who wins. Onto the currencies. I mentioned earlier, institutional investors, hedge fund managers, they're bearish the dollar. In fact, fund managers are now the most bearish they've been in 20 years. You can see that from the chart here. If everybody's short, the risk is, of course, then that the dollar goes the other way. And you can see here the chart, next chart shows dollar yen breaking aggressively higher. Again, I took this chart earlier. It's up another 50 pips since I took this slide of dollar yen. You can see it's clearly broken the trend line. Shorts in that market are hurting.
Yeah. It's from my view at least, it's kind of double pronged. We have that hugely crowded trade, which the short dollar, which is going to be unwinding, but then also we have last week's FOMC, which will be...
Yeah, and the target here is the previous high. So the first target is 148.80. So we're about 100 pips away from that. That's where you typically sun profit taking. Yeah, it pull back slightly, and then it's the next move. Does it continue high or?
And I mean, also we have seen a little bit softer data out of Japan, which might see pricing of hikes there kind of delayed.
The flash PMI this morning though picked up. So the flash PMI came in at 51.2.
Yeah.
But manufacturing PMI turned positive first time since April. So again, just flash PMIs, but I agree the data had been looking weak.
So I mean, we saw that kind of that first cut shifted back to January now. So, but yeah, it's in flux. It's the OIS. You never know. Tomorrow it might print the other way.
If we move on, the next chart shows you the dollar index. You can see how that's just starting to break out. But again, that's a far better trend line. It's held many times. Again, trend lines, you may believe them, you may not believe them, but a fact is a lot of people use them and they'll use them for their stops. So you know what other people will be doing? They will be buying the dollar, selling euros on the back of this, buying dollar yen, as we mentioned, selling cable. If the market uses it for stops, and then we start to get a bit of a flow, a bit of a build in the dollar long position, then all of a sudden more stops get triggered, and that's why markets don't go in straight lines. They move in waves. They trend and then they pull back and they trend again and pull back.
Yeah.
This next chart actually is my favorite chart at the moment. This shows the correlation between the gold and the dollar index inverted. So here you can see how highly correlated they are. When the dollar's weakening, gold's getting stronger. That's partly to do with this whole debt trade. Well, the last week we've seen dollar suddenly strengthening and gold has sold off. We'll have gold chart in a second, but to me, that's a pretty telling correlation.
Yeah, I mean, gold's been really interesting. It's been, well, clearly benefiting from a lot of safe haven flow for a while.
We have a chart in a second as well as central banks buying gold since the financial crisis. That was a turning point.
Yeah, and recently silver's been performing, which has been interesting as well.
Yeah, we have the gold chart up next. You can see how gold, it's in a clear wedge here. The top of the range, 3,430. The first line of support would come in at 3,240. Yeah, a week ago, people would say, it's breaking higher. There's no chance it trends back to or reverts back to 3,240. But now you can see actually there's a clear chance it does, and two fairly clear trend lines.
Yeah, I mean, it's interesting as well because fundamentally not that much has changed in kind of the bullish gold thesis. Like we still have inflation risk, we still have central bank buying. In
fact, if anything, you buy more of a safe haven on events in the Middle East.
Yeah.
But a good example to show the price action is ignoring, in this case, the current.
But headlines. Again, those gold silver ratios were so blown out. Perhaps you're just looking for other precious metals instead at this point.
You can see from the next chart as well, you can see this highlights central bank buying really came in after the financial crisis. Central banks have been selling, turned buyers, and you can see the last 3 years just how aggressive that buying has become. If we go back one chart to gold, you can see 3,430. If we break above that level, then we're going to get a huge amount of buying come in. Because when you get a consolidation like this, the longs will unwind their positions, they'll wait for the break, then they'll go back in, and you typically see an aggressive surge higher.
Yeah, I mean, in oil, we always talk about the Chinese put. When oil breaks down toward like below 70, China will come and buy in for strategic reserves. I wonder if we might see a similar thing with gold here, where we have a bit of a floor on the market where if it reaches this point, then central banks will just come in and hoover it up.
Absolutely. Moving on, last few weeks we've been looking at hedge fund managed positions, but this time we're looking actually Goldman Sachs have come out over the weekend picking stocks they like. They've looked at China and they're looking at the stocks that would most mimic the Magnificent Seven in the US, and they're calling them the Prem 10, the Premier 10 stocks. You can see Tencent, Alibaba, Xiaomi, have I pronounced that correctly?
Xiaomi.
BYD, amongst others. So this is what Goldman Sachs think will be the prominent Chinese stocks going forward.
Interesting. I mean, yeah, it definitely those top four. I'd definitely agree with. I mean, BYD's their sales have just been astronomical and just continue to perform.
But having said that, they're selling their cars so cheaply, but their profits will be weak now. But again, what they're doing is they're crippling. They're destroying their competitors, aren't they?
Exactly. And they've expanded globally, huge amounts. So, we're seeing more crop up in Europe.
Yeah, without a doubt. And I went on one in Singapore. I mentioned this about 3 weeks ago. I was amazed at the quality. I was fairly cynical beforehand, but I was really impressed.
And South America as well. They're really trying to push expansions into South America, which is a completely untapped market. And with that, they'll also get the charging infrastructure as well. So it's a lot of strategic expansion here. Perhaps a little bit loss leading in some areas, but they can afford to do that. They have the supply chain.
And the majority of the global population buying cars, cost is the number one issue.
Exactly.
And these are by far cheaper than the others.
Any sort of competitor, yeah.
Absolutely. Bitcoin, interesting Bitcoin price action here. Again, it's gone sideways for a few weeks, and actually this morning it opened below key support, but risk has gone back up with the sell-off in oil, and here it's sitting just above key support, 100,420, near enough 100,000, but you can see again a key level there. It closes below there. Love it or hate it, Bitcoin stops will get triggered and we'll see a move lower.
Yeah, definitely.
So the central bank, the OIS pricing over the next 12 months, well, the Fed exactly 2 cuts priced in by year end, 81 basis points over the next year to 3.52%, just by the Bank of England. ECB, less than 1 cut now by year end.
Yeah, I mean, they're certainly approaching terminal. They had, last month before they cut, they were already saying they were at neutral. So that might be implicit that they're now in a more accommodative policy stance. I'm
caught here between two sides. We have this huge stimulus package coming in Germany, but at the same time, inflation's falling, was it 0.7% CPI in France?
Yeah.
And it's going to go down as China floods Europe with its exports.
Yeah, and we saw that with steel a couple of years ago. So that is going to weigh on the headline inflation statistic. I think they're probably going to err on the accommodative side. As we discussed earlier, neutral and terminal is perceived to be much lower in Europe than in the UK or the US. So,
year's time, ECB priced 1.69%.
Yeah.
UK and US just over 3.5%.
Yeah. So and that's structural.
Yeah.
That is a feature of the European economy.
My chart of the week. This week I brought up Meta. Reason being, you can see the trend line, similar trend line we're seeing in the S&P, we've been seeing with Nvidia, but this one has broken. I'd like to see a close below here, so below last week's low as well, but you can see that, to me, that looks like it's rolling over. A close below here, I would say Meta goes into a downtrend.
Yeah, I mean, it certainly looks precarious here, like breaking below that key support. I mean, it's one of those just heavily overvalued stocks, just doesn't support price to earnings ratios at all.
And to me, this just highlights how fragile the whole equity market is. We see this breaking lower, then we'll see the S&P breaking support.
Yeah.
How low it will go, I don't know.
No.
But we drew a retracement at these levels, I think.
Yeah, definitely.
So what do we have coming up over the next week? Today, Eurozone, UK and US flash PMIs. Tuesday, we have Canadian CPI and German IFO business confidence. Wednesday, US mortgage applications and new home sales. Normally they're being ignored, but I think they're slowly taking on more importance. Thursday, of course, US jobless claims, again, starting to take on more importance with jobless claims ticking up 248,000, but trending higher.
Yeah, I mean, it's kind of settled at a slightly elevated level.
It was 220 for many months. Now it's around 240 to 248.
Yeah.
But it's
and we're seeing that come through into the continued claims as well,
Yep.
which are now kind of the highest since 2022, I believe. So they're not concerning at these levels.
weakness in the employment market, but not.
But it's trending one way.
Exactly.
So
Friday, we have Tokyo inflation, Japanese unemployment retail sales. Key one on Friday, US PCE price index, and of course, University of Michigan consumer sentiment. But I think the week's going to be dominated again by headline risk, watching Twitter, and see how that plays out. What are your thoughts on the week ahead?
Yeah, I think, absent of a full-blown retaliation from Iran on US assets in the Middle East, we'll see kind of a calming, especially in oil markets. And I think that scenario is pretty unlikely. We've seen before when Iran have retaliated, it's been largely performative, a saving face kind of style retaliation. There have been talks between Iran's foreign minister and Putin, and he also went over to China as well. So it'll be interesting to see what comes out of that. Russia's pretty tied up in Ukraine, so in terms of direct military support, they're going to struggle to provide any help to Iran there. But you never know what Putin might try and facilitate with China. So that's one thing to watch. But I think it's going to largely be de-escalation from here. It's in Trump's favour to kind of wind things down.
Yeah, and stepping away from oil, I think the key things are to watch the dollar. If the dollar continues going high, that's going to hit gold.
Yeah.
And the other point is US equities. They're on key support level. It may bounce from here. I don't know. The price action will tell us. But I think a break would see a pretty aggressive stops getting triggered.
Yeah.
Lots to look forward to this week. Hopefully we'll see you next week on Macro Monday. Thanks for listening. We'll see you next week.